Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Pentair was founded in Minnesota in 1966 as an industrial pump manufacturer. Through decades of acquisitions and a strategic 2018 spin-off of its electrical business, it is now a focused, pure-play water management company.
Three segments define the business. Flow handles residential and commercial pumps, Water Solutions covers filtration and softeners, and Pool is the high-margin equipment business, pumps, filters, automation systems that serves the U.S. pool market.
The pool segment is the crown jewel. Pentair pool pumps are installed in the majority of U.S. residential pools, representing a deep embedded base of replacement cycle demand that renews approximately every decade.
The moat in Pool is specification-based. Pool contractors and distributors recommend Pentair by brand name. Homeowners replace what their installer specifies, and Pentair has built those installer relationships over decades of training and certification programs.
Water Solutions addresses the residential filtration and softening market. Home water treatment is growing as consumers prefer purified water at the tap over bottled water, creating new unit demand beyond just the replacement cycle.
The Flow segment serves residential, commercial, and light industrial pump applications, residential water systems, pressure booster pumps for multi-unit buildings, and agricultural irrigation applications across global markets.
The 2018 nVent spin-off was a clarifying strategic move. Separating the electrical enclosures business unlocked Pentair's water identity and allowed management to focus capital allocation entirely on water technology adjacencies and acquisitions.
Pool segment. EBIT margins around 25% reflect pricing power built on brand loyalty and specification-based demand. The premium over Flow reflects value embedded in a long replacement cycle business with limited price sensitivity.
The pandemic created an extraordinary pool construction boom as homeowners invested in outdoor living. That demand surge created a challenging normalization in 2023 as new pool construction slowed and dealer inventory destocking began.
John Stauch became CEO in 2018 and has guided the portfolio refinement, maintaining price integrity through the pool demand normalization by protecting margins rather than chasing volume at deteriorating price points.
On the competitive radar, Pentair benchmarks against Xylem, IDEX, and Watts Water, all water infrastructure companies with similar margin profiles. Pentair's pool concentration makes it more consumer cyclical than pure industrial water peers.
Pentair is a dividend aristocrat with over 46 consecutive years of dividend increases. The consistency reflects resilient replacement cycle demand that underpins the Pool and Water Solutions businesses through economic cycles.
Operating in over 150 countries, Pentair's water management platform serves residential and commercial customers across developed and emerging markets, where clean water access and treatment standards are rising.
The long-term tailwind is fresh water scarcity and quality awareness. As global consumers focus on water quality and regulatory standards tighten, the addressable market for residential filtration and commercial treatment solutions grows.
That's the company chapter for Pentair. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Water is the defining resource of the 21st century, and one company has quietly built an entire business around making sure the world has clean, manageable, and reliable water wherever it needs to go. Pentair reported a solid first-quarter earnings beat this week, and today on Charged Alpha, we are going deep on the pure-play water story, the recurring revenue engine hiding inside your neighbor's backyard pool, the compelling industrial water treatment opportunity in semiconductor fabrication facilities and data centers, and the central question of whether the stock at around $70 still has enough room to run to justify paying a premium multiple for a mid-single-digit grower. I am Hudson, joined as always by the brilliant Lana, and this is Charged Alpha, your deep dive into S&P 500 earnings every quarter, one company at a time. Stay with us.
Pentair trades under the ticker PNR and carries a market cap of roughly $12.8 billion. The company designs, manufactures, and services water treatment, filtration, and flow control systems across a broad set of end markets. On the residential side, Pentair dominates pool and spa equipment, pumps, filters, heaters, salt chlorination systems, and sells home drinking water filtration and purification products. On the commercial and industrial side, the company serves building management, food and beverage processing, semiconductor fabrication, and data center cooling applications. Pentair reached its current pure-play water form in 2018 when it separated nVent Electric, the electrical enclosures and infrastructure business, as an independent publicly traded company. What remained after that spin-off is a tightly focused water franchise with manufacturing, engineering, and distribution operations spanning North America, Europe, and Asia-Pacific, serving customers who depend on reliable water management across nearly every segment of the global economy.
Pentair delivered a clean first quarter 2026 earnings beat that reassured investors who had been watching for signs of stress after some softness in residential pool demand in recent quarters. Adjusted earnings per share came in at $1.22 against the Wall Street consensus estimate of $1.17, a beat of approximately 4.3%. Revenue for the quarter landed at just over $1.027 billion. Management reaffirmed full-year guidance following the print, which is a meaningful signal that the Q1 outperformance was not a one-time event driven by favorable timing or transient product mix, but rather reflects genuine underlying operational momentum. The beat was driven by better-than-expected margin execution in the pool segment, improving throughput in the industrial water treatment business, and continued disciplined pricing across the broader product portfolio.
Digging into the income statement, Pentair's revenue of roughly $1.027 billion in Q1 reflects the company's diversified exposure across residential, commercial, and industrial water end markets. Gross margins have been a consistent strength throughout recent periods, supported by price realization and a favorable mix shift toward higher-margin aftermarket products, the replacement parts and consumables that pool and water system owners purchase on a recurring, non-discretionary basis, rather than the capital equipment that is purchased only once during the initial installation. Operating leverage in this model is meaningful precisely because a substantial share of pool segment revenues come from filter cartridges, salt cells, and maintenance consumables rather than from new system installations. Below the operating line, interest expense is manageable given the company's balanced capital structure and the debt reduction achieved following the nVent separation. The EPS beat reflects both genuine operational outperformance and the mathematical benefit of an ongoing share repurchase program that has been reducing the share count over time.
The signature competitive advantage at Pentair, the thing that makes this business worth paying a premium multiple for, is the aftermarket flywheel embedded within the pool segment. Here is how it works. When a homeowner installs a Pentair pump, variable speed controller, or salt chlorination system, that homeowner is functionally locked into Pentair-compatible replacement parts and consumables for the lifetime of the pool. Filter cartridges need to be replaced every season. Salt cells wear out and need replacement every 3 to 5 years. Automation controllers get firmware upgrades. These are not discretionary purchases. Once the pool exists, the maintenance purchases are essentially mandatory. Pentair has built a massive installed base spanning millions of residential pools across the United States, and that installed base generates recurring, relatively price-inelastic revenue that is defended by brand recognition and compatibility rather than pure commodity price competition.
On the cash flow and balance sheet front, Pentair has historically been a strong free cash flow converter relative to reported earnings. The capital-light character of the aftermarket portion of the business, where you are selling consumables rather than building heavy industrial equipment, means that earnings translate to cash at an attractive and consistent rate. The company has deployed that cash flow to fund a reliable dividend, a steady share repurchase programs, and bolt-on acquisitions that extend its water treatment and flow control capabilities into adjacent end markets. Debt levels are moderate and well managed following the nVent separation, and the balance sheet provides genuine strategic flexibility. Management has communicated a disciplined capital allocation framework that prioritizes organic reinvestment first, then shareholder returns through buybacks and the dividend, and finally opportunistic M&A in adjacent water technology businesses.
Capital returns are a meaningful and underappreciated part of the Pentair investment case, and one that often receives less attention than the water scarcity thematic or the aftermarket flywheel. The company pays a regular cash dividend and has maintained a consistent share repurchase program across multiple years and varying economic environments. Buybacks reduce the outstanding share count over time, and because the aftermarket-driven business generates predictable and recurring free cash flow, the repurchase pace has been reasonably steady without requiring any single unusually favorable macro tailwind to sustain it. Pentair is not positioned as a high-yield dividend stock. The yield at current prices is modest compared to utilities or real estate investment trusts. But the combination of the dividend plus ongoing buybacks provides a meaningful total capital return to shareholders that supplements price appreciation. Management's consistent multi-year commitment to returning excess capital signals genuine confidence in the durability and long-run visibility of forward free cash flow generation.
Management has laid out a focused long-term growth strategy built around three secular demand drivers. First, water scarcity solutions for stressed global markets, where governments, utilities, and large industrial operators increasingly need to treat, recycle, and conserve water as supply constraints intensify. Second, smart water technology, connecting pumps, controllers, and treatment systems to digital platforms that enable remote monitoring, automated chemical dosings, and predictive maintenance across residential, commercial, and industrial installations, building a recurring data and service revenue layer on top of the hardware base. Third, industrial water treatment expansion in high-growth verticals, most notably semiconductor fabrication and data center cooling infrastructure. The semiconductor angle is particularly compelling because leading-edge chip fabrication plants require enormous volumes of ultra-pure water at every production stage, and the quality and reliability standards are exacting enough that switching away from a trusted supplier carries significant operational and regulatory risk. Any acceleration in domestic semiconductor investment or federal water infrastructure spending would serve as incremental catalysts.
Analyst sentiment on Pentair leans toward a mixed but modestly constructive hold-to-buy consensus across the major sell-side desks covering the specialty industrial machinery and water technology space. The average price target in the mid-$70 range implies meaningful upside relative to the current stock price of around $70. The bulls in this group point to the recurring and structurally high-quality nature of aftermarket revenue, the durable water scarcity thematic, and the still-improving industrial water treatment penetration story in semiconductors and data center infrastructure. More cautious analysts flag the premium earnings multiple relative to Pentair's mid-single-digit revenue growth rate, the acknowledged sensitivity of the new pool installation business to the residential housing cycle, and consumer confidence, and competitive pressure from well-resourced rivals Hayward and Fluidra in the pool equipment market as reasons to temper enthusiasm. Historically, Pentair's stock has commanded a meaningful premium to the broader industrial machinery group, given the earnings quality and recurring revenue mix.
On valuation, Pentair commands a premium multiple relative to broad industrial machinery peers, which is broadly defensible given the recurring revenue mix and the ESG-aligned water thematic that attracts quality-focused investors. At around $70, the stock trades at a meaningful premium on a forward earnings basis compared to general industrial companies, though that premium is narrower when you compare it to specialty industrial companies with similarly high aftermarket revenue content. The Wall Street consensus price target of approximately $76 implies upside in the range of 8 to 9% from current levels. Investors evaluating the name need to honestly weigh whether that premium is fully captured in the current price, particularly given that organic revenue growth in a normalized macro environment is likely to remain in the mid-single-digit range. The earnings quality is high. The recurring nature of the aftermarket business earns a premium. But what multiple that quality ultimately deserves is the central debate.
Bull case number one is the water scarcity secular tailwind, which is arguably the most durable long-cycle demand driver in Pentair's investment case. Global water stress is intensifying across multiple geographies simultaneously. The American Southwest, Southern Europe, the Middle East, and large parts of India, China, and sub-Saharan Africa are all facing structural water supply constraints that are not going to be resolved in a single policy cycle. Governments, municipalities, and large industrial operators are investing in water treatment, desalination, and water reuse infrastructure at accelerating rates as the cost of water scarcity becomes undeniable. Pentair's industrial and flow control segments are positioned to capture a growing share of this global investment. This is not a cyclical opportunity tied to any particular economic backdrop. Water scarcity is a structural multi-decade challenge, and the companies building the enabling infrastructure should benefit from durable demand.
Bull case number 2 is the data center and semiconductor water treatment opportunity, which is an underfollowed part of the Pentair story that could become a meaningful growth driver over the next 3 to 5 years. The explosion in artificial intelligence infrastructure and hyperscale data center construction is creating substantial new demand for cooling systems, and water-based liquid cooling is increasingly preferred over traditional air cooling at large facilities because of its superior energy efficiency characteristics. At the same time, advanced semiconductor fabrication at leading-edge nodes requires enormous quantities of ultra-pure water at every stage of the manufacturing process. Pentair has established industrial water treatment capabilities and existing customer relationships in both the data center cooling and semiconductor markets. As spending on AI infrastructure and domestic chip manufacturing accelerates, driven by the CHIPS Act and private investment, Pentair's industrial segment stands to benefit from a demand cycle that appears to be in its early innings.
Bull case number 3 is the smart water technology integration opportunity, which is about Pentair's ability to layer software and connectivity on top of its existing hardware installed base to build a more valuable and defensible business over time. Pentair has been investing in connected pool and water management systems, app-connected variable speed pumps, digital chemical controllers, remote automation platforms, and predictive maintenance tools that alert homeowners and service technicians before equipment fails. As this installed base of connected devices grows, Pentair is building a proprietary data layer on top of its hardware franchise that could eventually support higher-margin software subscription and professional services revenue. If Pentair executes this transition successfully, it expands its addressable market, deepens switching costs beyond pure parts compatibility, and earns a higher premium multiple as investors recognize the recurring software-like revenue component of the business.
Bear case number 1 is housing market sensitivity in the new pool installation business, which is a real and sometimes underappreciated cyclical exposure within an otherwise recurring revenue-heavy company. A meaningful slice of Pentair's pool segment revenues is tied to new pool construction activity. And new pool construction is directly correlated with housing starts, consumer confidence levels, home equity availability, and prevailing mortgage rates. When the housing market slows, because interest rates are elevated, affordability deteriorates, or consumer confidence weakens, homeowners defer discretionary improvements, including pool additions, and the backlog of new installs contracts. The pandemic-era pool boom that drove extraordinary demand growth from 2020 through 2022 has clearly normalized toward a more modest pace. That and a prolonged period of housing market weakness could continue to suppress the new installation side of the business, slowing the rate at which Pentair is adding fresh members to its recurring aftermarket installed base for future years.
Bear case number 2 is the twin risk of competitive pressure in the pool market and premium valuation compression if growth disappoints. On the competitive side, Pentair faces capable, well-capitalized rivals in Hayward Holdings and Fluidra that are investing aggressively in smart pool technology, connected controls, and aftermarket parts, the exact categories that underpin Pentair's recurring revenue moat. A sustained competitive dynamic in pool equipment pricing would pressure gross margins and force Pentair to invest more in retention to defend its installed base. On the valuation side, the premium multiple embedded in the stock price leaves limited room for any meaningful earnings miss or guidance reduction. If top-line growth comes in below expectations, whether from housing weakness, competitive share loss, or broader industrial demand softness, the multiple contraction alone could offset underlying earnings growth and produce flat to negative total returns, even if the core business performs acceptably.
Bringing it all together, Pentair is a high-quality, pure-play water company with a genuinely durable aftermarket revenue engine, compelling secular tailwinds in global water scarcity and industrial water treatment, and a management team that has demonstrated consistent capital discipline and operational execution. The Q1 earnings beat and full-year guidance reaffirmation support near-term confidence in the business trajectory. The core risk in the investment thesis is that the premium valuation requires sustained execution without stumbles, and the housing-sensitive new pool installation business introduces real cyclicality that can frustrate shareholders in a prolonged rate environment. The consensus price target of roughly $76 represents modest single-digit upside from current levels, and the Pentair investment case is best suited for patient, quality-oriented investors who believe that water infrastructure spending is one of the most durable secular growth themes of the coming decade. Financial data sourced from Financial Modeling Prep. Charged alpha is for educational purposes only and does not constitute investment advice. Always consult a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.